Imagine trying to make important choices when the very rules of the game keep changing. How clearly could you plan for the future, or decide where to invest your energy and resources? This challenge is precisely what economies face when inflation becomes unstable. Yes, inflation can absolutely cause a significant misallocation of economic resources. When prices are fluctuating unpredictably, the clear signals that guide producers and consumers in a healthy market become distorted, leading to inefficient decisions and investments that do not truly reflect the economy's needs or real value. The core mechanism behind this misallocation lies in inflation's distortion of price signals. In a stable economy, prices act as vital messengers, communicating information about supply and demand. They tell businesses what goods and services are most valued by consumers, and they inform consumers about the relative costs of different products. When inflation is high and volatile, however, distinguishing between a change in relative prices, which signals a genuine shift in demand or supply, and a general increase in all prices due to inflation becomes incredibly difficult. This muddies the waters, causing economic actors to misinterpret market conditions and make suboptimal decisions. To counter this, economic actors might overinvest in physical assets like real estate or durable goods as a hedge against inflation, rather than in productive capital that would enhance long-term growth and innovation. They may also divert resources toward activities focused on anticipating or reacting to price changes, such as constantly repricing goods or seeking out inflation-resistant investments, rather than focusing on their primary business operations or increasing productivity. Furthermore, individuals might alter their savings and investment behaviors, potentially favoring short-term consumption over long-term wealth creation if they perceive their money losing value quickly. This phenomenon is often described by economists as inflation acting like a tax on clear information. The cost is not just the erosion of purchasing power, but also the opportunity cost of resources that are not directed to their most productive uses. Think of the intense focus businesses place on managing cash flow and inventory during high inflation, efforts that could otherwise be spent on research and development or improving customer service. This diversion of effort represents a real economic loss. Ultimately, the ability of an economy to efficiently allocate its scarce resources is fundamental to its growth and prosperity. When inflation compromises the clarity of price signals, it impedes this crucial process, leading to less efficient production, reduced innovation, and a lower overall standard of living for everyone. Maintaining stable prices is therefore not just about preserving purchasing power, but about ensuring the foundational integrity of market mechanisms that guide our economic choices.